with me now. Go with me now. I'm gonna take you down. Go with me now. I'm gonna show you how. Go with me now.
All right, how's it going? So today we're going to learn about the loanable funds market. And to kind of start us off, I just have a general question for you. If there was no such thing as a bank, how would you buy a house? Now think about that. The average house is over $200,000. Do you have $200,000? Okay, so the banking system is actually very, very, very important in our economy. And so that's kind of what we're going to start talking about today, except we're going to generically call it the loanable funds market. All right, so this includes anywhere where you can finance consumption spending or investment spending or government purchases. Okay, so it includes places like stock exchanges, investment banks, mutual fund firms, commercial banks. The point is that borrowers can get money for their purchases, and then savers use the financial institution to save money and earn interest that way. So in effect, savers end up lending to borrowers. Okay, so the loanable funds market kind of looks like this. This is kind of a flow chart. So we save our money. All right, so I'm just talking about households at this time. We save our money, we put them in a bank. All right, and so the bank is holding our money, and then a business borrows the money so they can make investments, building a new factory, a new office building, a new warehouse, buying equipment, all of those things. Okay, we're going to add to that though. Foreign entities also save money in the U.S., all right, and they put it into the loanable funds market. And then the borrowers, we're going to add to that. It's also the government, okay? And so the loanable funds market's a very, very big part of our economy. All right, so what we're going to be doing now is we're going to be drawing a market graph for loanable funds. Now notice I have labeled it or titled it Loanable Funds Market, LFM, up at the top. Now, the price of loanable funds is not price, it is real interest rate. All right, and then the supply of loanable funds, I'm going to go ahead and label as supply of loanable funds. That's the upsloping curve. And then we have the demand for loanable funds, and then we have the quantity of loanable funds. Now in a second, we're going to make a distinction between an open and a closed economy. And so right now I want to let you know that if we had just a closed economy, a closed private economy, the supply of loanable funds is just household savings. All right? So I've got it labeled as savings so that we can understand where the supply comes from. And then the demand for loanable funds is actually, if it was a closed private economy, it's just the investment spending that takes place in the economy. All right? Now, what we're going to learn today is what causes the supply of loanable funds or the demand for loanable funds to shift. And you can see if the supply for whatever reason were to decrease, that's going to cause interest rates to rise. And so we're going to see that interest rates are going to be affected by the supply and the demand for loanable funds. All right? So that's kind of where we're going. All right? So let's get that terminology down. A closed economy means it is just an economy that has consumption, investment spending, and then government purchases. That means there are no exports in the economy, okay, or imports. A private economy, now we're just talking about consumption spending, investment spending, and then the net exports. All right. The closed private economy is just consumption spending and investment spending. So we eliminate the government and we eliminate the foreigners. Okay? And the reason we do that is so that we can make a connection that the equilibrium in the loanable funds market is just going to be the savers lined up with the investors. Okay? So again, saving money in banks so that firms can borrow. Then with the open economy, that includes everybody, you have foreign entities saving and governments also borrowing. All right, so in a closed private versus open public economy, this is kind of the difference. And by the way, don't freak out about the difference because it's not that big a deal. Anyway, real interest rates is going to be the axis on both of these. In a closed private economy, the supply is household savings, and the demand is investment. And that is why, at that equilibrium, we would say that savings equals investment. And then we have the quantity of loanable funds. Now, when we open the economy up and we include foreigners and we include the government, no longer can we say that savings is just household savings. Okay? It is still savings, but it's foreign savings included with domestic household savings. And then the demand for loanable funds is no longer just investment. It will also include government borrowing. And so that's when we kind of draw it more broadly as a supply of loanable funds versus savings, and a demand for loanable funds versus investment. Okay, so that's kind of the difference. We're probably going to primarily just be drawing this one, but I wanted y'all to be aware that in the basic loanable funds market, savings will always equal investment at the equilibrium. All right, and this is why we kind of go with the more broad one, because our government actually owes $20 trillion to itself, to us, and to foreign entities. And so that's why it's important that we make the loanable funds market more broad. All right, so let's talk about why firms would need to borrow. All right, so when I talk about firms, we're talking about businesses. So let's pretend you have an idea for a hands-free selfie stick. In order to produce the hands-free selfie stick, you're going to have to, first you have the idea, but then in order to actually produce it, you've got to borrow money so that you can build a factory, buy the raw materials, and hire workers. Okay, so that's very important. So once you've borrowed that money, you've built the factory, then production begins, and you begin to sell the output. And when you sell the output, you can repay those loans, pay your workers, and maybe even reinvest into the company so you can do even more. And so the loanable funds market is integral to this thing. Venture capitalists like this guy, they're the ones that kind of coordinate all of this. And so if we want our economy to grow, in other words, produce more, there has to be borrowing taking place. All right? And if there's going to be borrowing taking place, that means there has to be savings as well. Okay? So lenders like the banks, they cannot lend money they don't have, and they get that money from your savings. Okay? So the chain of borrowing is where we have to have investment spending. Investment requires borrowing. Borrowing requires savings. And the loanable funds market makes this process efficient. And the interest rate will either encourage or discourage saving and or borrowing. Let me give you an example of what we mean by this. Okay? So we have our real interest rate here. You have the supply of loanable funds, the demand for loanable funds, the quantity of loanable funds. Whoops. And let's say that you have that great idea for the hands-free selfie stick. As a result, you are increasing the demand for loanable funds. Okay? That in turn will cause the real interest rate to rise. When the real interest rate rises, savers have a bigger incentive to increase their savings. And so you end up moving along the supply curve because savers are going to save more money at higher interest rates. And so the interest rate ends up coordinating savings and investment, so that at that equilibrium, savings equals investment. Okay? So this is kind of a reiteration of what we just said. So if the interest rate is 3%, if you save $500, you're earning $15 a year on that savings. Okay? That's because 500 times 0.03 is $15. As interest rates rise, people are going to increase the quantity of their savings. Okay? So that's basically what we're talking about. Now, let's look at interest rates as a cost of borrowing. All right? Interest rates are going to either incentivize or disincentivize borrowing for production. Because it costs money to borrow, if you're not going to realize profits that are greater than the interest rate, then there would be no reason to borrow. Okay? So, if a business needs one of these, okay, that's a backhoe on a track. That's an expensive piece of equipment. If they cannot make additional profits by buying that, there would be no reason to buy that. And those profits, the expected return on the investment, must be greater than the interest rate on the loan. Otherwise, it would not make sense to borrow the money to buy that. In fact, if you look at the demand curve for loanable funds, it's downsloping, right? The reason it's downsloping is because at higher interest rates, it becomes less profitable to borrow money and make investments. If, on the other hand, you have lower interest rates, it becomes more profitable to borrow money and make those investments. So, for example, to renovate the plant, it's going to cost you $2 million. You have to borrow that money. Okay, the return on that investment is 27%. Okay, that's a pretty high return on investment. So that would support a pretty high interest rate. On the other hand, if you're installing a new computer system, the return on investment is only 7%. And so interest rates would need to be lower for that to become profitable. And so as you get lower interest rates, more and more investment opportunities become profitable. And that is why the demand curve is downsloping. All right, so here's a very important principle. All right, in a loanable funds market, that equilibrium point, we're going to make the claim that savings will equal investment. So at that point, $250 billion is saved and $250 billion is borrowed to make investments. Okay? Don't forget, investment is the purchase of capital, meaning machines, tools, equipment, buildings, factories. Okay? So every dollar borrowed requires a dollar saved. Now, we have actually already talked about the real interest rate, but let's remind ourselves that is the interest rate corrected for inflation. The nominal interest rate is the interest rate before it is corrected for inflation. There was an economist named Irving Fisher who came up with this relationship where he related inflation to the real and the nominal interest rate. So this is something that we've already covered, but I wanted to remind you, real interest rate is equal to the nominal interest rate minus the inflation rate. Or you can rewrite that same relationship to say that the nominal interest rate is equal to the real interest rate plus the inflation rate. All right? And if you look at real interest rates over time, you will see that the real interest rate, or the nominal rate rather, will fluctuate up and down throughout time. The lowest it can go, though, is 0%. Now, when you subtract inflation from the nominal rate, you'll see that the real interest rate has been negative many times. Okay, so it is possible to have a negative real interest rate, but it is not possible to have a negative nominal interest rate. All right. So, quick summary of the supply of loanable funds. The supply comes from people saving their money. All right. If you broaden it out to an open economy, it could include foreign entities saving their money in the United States. Why do we save money? Because we get an interest rate. All right. The demand for loanable funds comes from people who want to borrow that money. If it's a closed private economy, it's just businesses purchasing capital, and they have to borrow money to do that. So the interest rate is the cost of borrowing. So what is going to shift the supply of loanable funds? So now we're going to talk about the things that shift that supply curve either left or right. Okay? Now movement along the curve is just caused by changes in the interest rate. Okay? But a shift in the supply of loanable funds can be caused by many things. Okay? We're going to talk about these individually. But it could be changes in our income. It could be changes in time preferences. Okay, we're gonna be talking about that one in detail. It can be confusing. And then there's the concept of consumption smoothing. These all cause shifts in the supply of loanable funds. And to kind of kick it off, just imagine this. When your income rises, do you spend more money? I'm pretty sure the answer is yes. But you're also going to save more money. So higher income is going to result in more savings. Okay? So let's label this thing up again. Real interest rates, supply of loanable funds, demand for loanable funds, quantity of loanable funds. If we have an increase in income, that is going to cause us to have more money that we are able to save. And so we're going to end up shifting the supply of loanable funds to the right. When that happens, interest rates fall. Okay? Makes sense, right? Now, people want to save their money where interest rates are highest, and that is why we end up getting some foreign investors saving in the US. All right? Now, the next thing is we're going to be talking about time preferences. And to introduce time preferences, I just want you to think about this. This meme says it all. When do you want things? You want it now, right? So, if you want things now, what are you going to do with your paycheck? Are you going to save it or are you going to spend it? Okay? And by the way, everybody's a little bit different. But let's pretend that on average, more and more people want it now. So instead of saving your money for a new car, you're going to go borrow that money. All right, so two things could end up happening, but let's focus on the savings side. If you decide to spend your money because you got to have that thing now, instead of saving it, you're going to cause there to be a decrease in the supply of loanable funds. All right? If, on the other hand, you're more patient, you can wait, you don't have to have it now, you'll end up saving more money. And so the supply of loanable funds would increase. All right? All right, so let's talk about time preferences in more general details here. So time preferences is referring to when you want things. Okay? If you want things now, you have high time preferences. Okay? If you can wait, then you have low time preferences. Okay? Many people prefer to have things now, and so they're going to spend their money now instead of save it. Makes sense, right? Time preferences are not uniform across individuals or societies. Generally speaking, the least patient people strongly prefer now to later, and so they'll save less. Those people have high time preferences. Okay? If, however, you are more patient and you can wait, then you have low time preferences. And so these time preferences help to determine the nation's savings rate. Okay? So, when you have high time preferences, that means you want it when? You want it now. And so your consumption spending will increase. That means your savings have to decrease. So, on our loanable funds market, let's see here, we got demand. Let's color this red. So high time preferences means there's going to be less savings. That's going to result in higher interest rates. Okay? On the other hand, when you have low time preferences, that means you can wait. You don't have to have it now. Your consumption spending tends to decrease. Your savings will increase. And so when savings increases, the supply of loanable funds shifts to the right, and that causes lower interest rates. Okay? Cool stuff, right? All right, let's talk about consumption smoothing. So, what we are talking about here is the fact that throughout our lifetimes, our income is going to change quite a bit. Okay? When we're young, we don't make a lot of money, and so when we start out in life, our incomes are low. As you move into your prime earning years, usually between 40 and 60, your income, reaches a maximum point, and then later in life, as you retire, your income drops. Now, that's true for income. However, notice what happens to our consumption spending. When we're early in life, we tend to spend more than we earn, and so we have to borrow money. Okay? But as we get older, we begin to save more than we spend, or save more of our income. So our consumption spending is less than our income. And then later in life, we begin to spend those savings. So, basically, what we're saying is when a society's demographics change, if they have more young people, there's going to be more borrowing. If your society is more middle-aged, there's going to be more savings. And if your society is generally old, there's going to be less savings. Make sense? Cool. So borrowing means less saving. Saving means more saving. Dissaving also means less saving. So consumption smoothing is going to also help determine the supply of loanable funds. So let's look at an example. All right, so here's our graph of consumption smoothing. Put it up there the way it was. Whoops. And now we're going to draw a loanable funds market graph. So we have our real interest rates. You've got the supply of loanable funds. We got the demand for loanable funds. We've got a quantity of loanable funds and so on. So what happens to our nation's rate of saving if the majority of population is in their midlives? So the midlives means here. That means increased savings. So the supply curve shifts to the right. That means interest rates fall. Okay? If, however, we are mostly young or mostly old, either or, then there's going to be less savings. And so the supply curve shifts to the left, raising interest rates. All right? So that's consumption smoothing. Now let's talk about the demand for loanable funds. All right? The demanders of loanable funds are going to be any entity that wishes to borrow money. All right? It is largely driven by firms who want to borrow money, and they need lots of financial capital to build real capital. So an example I have here is Apple borrowing money so they can build new distribution centers, new factories, new warehouses, new office buildings. Okay, that's an example. Governments also borrow. So in order for there to be borrowing, first we have to have savings. And the reason firms borrow is so that they can make investments or they can increase production. All right. So let's make sure we're clear about the difference between the shift and movement. Okay. So let's draw this out again. Quantity of loanable funds. For whatever reason, we increase our savings. Okay. That's going to cause interest rates to go down. The lower interest rate is going to incentivize borrowing. And so you get movement along the demand curve. So you do get more borrowing as a result of increased savings. Okay? But now we're going to focus on shifting the demand for loanable funds. So the first cause would be anytime there's changes in the productivity of capital. All right, a firm is not going to borrow money to buy a machine that is not going to help them produce more. They're going to borrow money to buy a machine that does help them produce more. So these robots on this factory, they're doing the welds on these trucks. Okay, they're very valuable because they're replacing a lot of expensive labor. So that would be a reason to borrow money. Okay, could be changes in investor confidence. What we're talking about there is just business owners' confidence in the economy. If the economy's strong, they're going to borrow money and expand. If it's weak, they're probably less likely to do that. Okay, then you've got changes in government borrowing. So whenever governments borrow money, you're going to have an increase in the demand for loanable funds. And then lastly, whenever consumers borrow a lot of money, you're going to have a change in the demand for loanable funds. So let's look at these things more individually. So the productivity of capital is just referring to how much production how much can you increase production when you purchase this capital. Okay? If you ran a business, are you going to borrow money to buy that computer? Or maybe this one? Well, the one on the bottom is much more productive, so you'll probably borrow money for that. Are you going to borrow money to buy this screwdriver or this drill? Okay, so that's what we mean by productivity of capital. Okay, investor confidence, we're really talking about just emotions, really. You know, if a business owner thinks the economy will grow in the future, they will be more comfortable borrowing money today to expand their operations. Okay. If however, they feel a recession is coming, they are less likely to do that because they don't want to put themselves on the hook for a loan when they don't know what's going to happen in the future. All right? So that kind of makes sense, right? So investor confidence tends to decline when the economy slows. It tends to go up when the economy is growing. Okay? Now I want to show you something. Look at this graph. So on the right, we have a demonstration of what has happened to investment spending in the economy over the last 17, well, this is really only 13 years. There were two recessions. Okay, these two gray areas are recessions. You can see what happens to investment during a recession. Okay, it drops. And the reason it drops is because business owners lose confidence. If you look at that exact same phenomena on a loanable funds market graph, you can see that in 2007 we had that demand for loanable funds. But as the recession carried on, the demand for loanable funds decreased. So by 2008, there was less investment spending, therefore less demand for loanable funds. Okay? And when there's less demand, interest rates fall. All right? The last thing is increases in borrowing by governments or individuals. Okay? When a government increases spending, they either have to increase taxes, okay? And by the way, well, never mind. I don't want to get confusing here. Or they have to increase borrowing. Now, as you know, we have a $20 trillion debt. So what is it that governments typically do to increase spending? They increase borrowing. So on our loanable funds market graph, when a government decides to increase their spending, that means there's going to be an increase in demand for loanable funds. And that's going to cause interest rates to rise. Cool deal? That means when governments and consumers increase borrowing, the demand for loanable funds increases. All right. Now let's talk about, we're going to be discussing this another day, but I want to make sure y'all are clear on something. When real GDP increases, it can be caused by any time there's more consumption spending, more investment spending, an increase in government spending, or an increase in our net exports. That will all cause GDP to increase. Now, I'm going to tell you that that is not that big of a deal, okay? But economic growth is a big deal. This is when we're expanding that PPC outward. And the only way to get economic growth is to have an increase in investment spending. And so that's why interest rates are so important to this economy. Lower interest rates are going to increase investment spending. Higher interest rates are going to decrease it. So it's very, very important. To get economic growth, we have to have investment. All right? Now let's look at what could be happening in the loanable funds market in the future. Number one, we have less savings today, okay, because we have an increase in time preferences. We want things now, we're always shopping, okay? That causes a leftward shift in the supply of loanable funds. However, foreign savings up to this point have been high. Okay, we talked about this in Unit 2. When we spend money in China, China turns around and saves that money in the U.S. So that tends to shift it back to the right. But on the other hand, we've also got retiring baby boomers. Okay, when they start spending their accumulated savings, that's going to shift the supply curve back to the left. Okay? And so the end result could end up being less investment in the economy and therefore less GDP growth. So all of these things are very, very important. So let's answer a couple of questions where we're going to use all of what we just covered to analyze what happens to interest rates. All right. So to start out, here's what we have. We have a loanable funds market where savings and demand are represented. When household savings continue to decline, okay, that's going to shift the supply curve to the left. Okay? If China stops financing U.S. debt, that could shift it to the left further. And when baby boomers retire, that could shift it to the left even further. So if all those things were to happen, we would see much higher interest rates, which means everything is going to cost more. For you personally, that means your student loans are going to be more expensive. When you look at our government debt, financing that debt is going to become more expensive. If you want to buy a house, it's going to be more expensive. So interest rates are very, very important. All right? So let's keep on rolling here. So this is what you could expect on a quiz over this subject. If the largest demographic group is retired people, what happens to the interest rate? So if we have a whole bunch of retired people, that means those retired people are going to start drawing down their savings. And when they draw down savings, that means the supply of loanable funds shifts to the left, and we get higher interest rates. All right, what if the government continues to deficit spend? Deficit spending is referring to borrowing in order to spend money. Well, when that happens, they're going to have to go borrow the money in the loanable funds market, driving demand higher and therefore raising interest rates. So interest rates would rise. It says here millennials are the largest American demographic. If they have trouble getting high-paying jobs, what will happen to interest rates? Well, if you don't have a high-paying job, do you have money to save? Probably not. So the savings is going to decrease, and we're going to have higher interest rates. If businesses lose confidence in the profitability of increased investments. So if businesses don't feel confident, are they going to borrow money and make those investments? Very unlikely. So the demand curve is going to shift to the left. That would lower interest rates. And what if our incomes fall? Like, let's say we're in the middle of a recession, our incomes fall. Are we going to be saving as much money? Probably not. So supply curve shifts left, interest rates rise. Here's another one. If China continues to put money in our financial markets, so we're buying tons of goods from China, they have all these dollars, they decide to put them back in the US, that would be an increase in the savings here, and so the supply curve shifts right, and you get lower interest rates. So all of these things are very dynamic in what they end up doing to the economy. Okay, if Donald Trump successfully beats China and China has fewer US dollars to buy US bonds with, well, then you're going to have a decrease in the supply of loanable funds, higher interest rates. Bernie Sanders wins the presidency, convinces Congress to borrow money to pay for everybody's college. Well, that would cause an increase in demand for loanable funds, and interest rates would rise.